audio check before we begin. I know I was talking to a few of y'all before before I started here, but if you guys can hear me and I'm gonna flip the screen on over, go ahead and give me a Y or a yes in the chat box. Just let me know everything is working here today. Let's see. Deward, good to see you. Rob, thank you so much. Steve, thank you. Paul, David H. Matt P, good to see you. Matt, I'm going to promote you as well, um, just so you can help me with any comments. Putting you to work, brother. I love you. Let's see. All right, perfect. So, all right. What happened there? All right, perfect. So, thank you so much. And let me also do this. Perfect. All right, perfect. So, got a few individuals in here, and one of my right-hand man, Matt Pagan's going to be helping out with some any comments that I miss and screenshots and stuff like that as well. So, excited to be here, folks. We got a lot that we're going to cover here today. As you know, kind of few things have happened in the last week. And we're going to be discussing it all. But before we do, got to let you know, not a commodity trading advisor, simply here to show you opportunity. What you do with that opportunity is all up to you, as well as you got to be aware of any and all risk, understand that risk, be willing to accept that risk and take on that risk. And any trades I cover here today, if you decide to take those trades, just know they are of and on your own volition. Now, for those of you guys that don't know me, my name is James Bishop. I've been in trading education for 15 plus years. I'm the founder of a managed fund, founder of a retirement and estate planning company as well. So with the managed fund, if you have assets that uh, we actually trade assets in people's accounts for them and for a fee, of course. And there are minimums and things like that to qualify for that. But on the retirement estate planning side, there are some amazing, amazing opportunities. Oh, no, no worries at all, Matt. You can head out whenever you need to. Just don't make sure you don't shut it down. And I can dismiss you if I need to as well. But on the retirement estate planning side, there's a lot of things that I am excited to bring you guys over the next few weeks, months, and days. Because there's huge opportunities out there, and I think right now is one of the most important times for a lot of people out there in offering protection from any downside risk. Yes, I just said that I can guarantee that you never lose any money that you invest with me, and that's a actual truth that I can tell you. Lastly, I have my MBA in finance and global portfolio management. I also help manage a endowment fund for the university that I'm getting my doctorate at right now as well. So a lot of things that I do, but really I enjoy doing these Sunday sessions because I like to speak to students with tools and resources that I use on a every single day basis for my own personal trading, as well as give you guys insight on news and how I'm digesting it. And then also we will go over anything that you guys want to look at as well. So the chat function, if you're not familiar with Zoom, let me screenshot this and then I'll bring it up. So to use the chat function, all you're going to do, you should have a panel down at the bottom. You click that chat button and bam, it'll pop open and you guys will be able to talk directly to me if there's any questions you have, anything I need to repeat, this, that, and the third. But I got some trading opportunities that I'm going to bring you guys as well. Lastly, purpose of this, why you guys are here. Andrew, good to see you, buddy. Market insights, showcasing tools, talking economics, learn from you all. All right. So let's get into it. Okay. And the first thing I want to do is actually jump into the news a little bit more than just starting in the charts. Okay. So let's talk news wise. So out of the US, we had CPI numbers, okay, which stands for Consumer Price Index. Now, there are two types of this CPI. There's core CPI and then there's regular CPI. Core CPI removes energy and food from costs. So from inflation, okay? Because the Federal Reserve, they can't control what food prices are. Natural disasters do that, import exports do that, tariffs do that, all sorts of different things can do that, but the Fed cannot. And the same with energy. We saw that it came in lower than expected. Now, excuse me there. Sorry about that. Now, here's the thing. When it comes to CPI, the letter channels, as I love to call them, your PBS, your ABC, your BBC, your MSNBC, all of them letter channels that you watch that stuff called news on, they all will say that, oh, inflation is no longer, inflation is not happening, right? We're seeing inflation stop. No, it's not. The rate at which prices are increasing is lower. That's all that means. If this was a negative number, then inflation is falling. That is what you call deflation. So that is one of those little, it's like one of those little, how do I put this? Like play on words that I hear in the news all the time. And it is so irritating to me because it's like, I know the majority of individuals don't get a chance to review this stuff and understand and stuff like that. And so people may not understand and they're thinking, wow, things are getting so much better. We're still seeing prices increase, right? Last month we saw prices decrease for all goods, but mainly in vehicles is what we saw. Um, we also had PPI numbers, which is the producer index. Now this is negative, and this is is a good sign here that prices are beginning to fall. It's the change in price of finished goods and services sold by producers excluding food and energy. So it's like I always use this example because it's really simple. Number two pencils, right? If I owned a number two pencil factory, so my input costs are, graphite, wood, yellow paint, aluminum, and rubber for the eraser. If all of those prices are decreasing, then either one or two things are happening. Either A, I can slow up how much I'm producing because there's such a excess of inventory that so prices will naturally fall that way. Or B, if the prices of my raw materials are going down, then my prices can come down as well. Now, the other side of that coin is that we also have to look at good old corporate greed as well. I hate to say it, but it's true. Meaning that, really think about it like even if their input costs come down and they've been charging, let's say I've been charging 50 cents for a number two pencil for the last 4 years, and now my prices have gone down, my input costs have gone down, but I don't have to change the price at the store. I can just make more money, which makes me more profitable, which puts more money in my pocket, right? That's the flip side of the coin. They can choose to lower their prices or they could be more profitable. Does that make sense to everybody? Give me a wire yes if that makes sense. Rob, I kind of agree with you. Price only goes down when your competitors lower them. Absolutely. I somewhat agree with you there. Because I am a firm believer that the only thing that fixes high prices is high prices, right? When people can no longer buy the thing stops getting sold, and then they say, "Oh crap, time to lower the price." Good evening to you, Charles. Good to see you. Let's see, right? Exactly. Right. So let's see. Exactly, Chris. So much less competition at this point for these corporate. Absolutely, there is. You know. Now, the other thing we got is consumer sentiment and inflation expectations. The expectations are inflation will sit around 7.3. They were higher than previous, right? So they still think inflation is coming. Tariffs in themselves are inflationary, which we will speak about tariffs here today. And then consumer sentiment is down again. So it is lower than it previously was, it coming in at 50.8, which brings me to one thing that I need to find. Let me see here. I know um mm, I can't find it, then I will do something a different way. But I know I have this here. Um Basically, I am looking for a doc that I have that kind of shows and illustrates. Here we go. Illustrates the top five indicators of a recession, right? GDP decline, which last quarter we saw the first quarter of negative GDP, a rise in unemployment. Okay. Chew, no worries, buddy. A rise in unemployment, consumer spending decline, which we haven't seen that yet, industrial production and retail sales stagnation, right? A decline in the production of goods and sales of those services, and an inverted yield curve. So we've had the inverted yield curve. We have not seen the production stagnation, have not seen the consumer spending decline. Unemployment rise, we haven't seen that yet, simply because the number from from the federal government hasn't been counted yet. That should come June, July numbers. So when that hits, then we'll see a little bit more unemployment. I'm also, reading Microsoft, they're laying off like 8% of their staff. Google's laying off another 3% of their staff. Ford's is going to be doing some hiring. So it's a little skewed for sure. Let's see. Doer, not a problem. And thoughts and prayers to you and your family on what you're dealing with there. I appreciate you. Just email me and let me know when a good time is, and I'll try to make it happen for you. Inverted yield curve, we had that 744 days, the longest time we've ever had an inverted yield curve. So just know that, hey, it's still on the table despite what we saw this past week in the S&P, and we'll talk about that as well. Now, coming up this week, really not a ton of things coming out. We have manufacturing PMI, which is Purchasing Manager Index, right? So this is where if we see this number stay below 50, right, which was 49.9 is what's forecasted, then what that means is industrial production and manufacturing is slowing. Didn't we just talk about something with that? Interesting how that works, right? You think I planned it or something. So the big announcement that you're going to be wanting to pay attention to is on Thursday, 9:45 a.m. Eastern Standard Time, with this PMI numbers coming out. We have it coming out for Europe and Great Britain as well. We have Australian interest rate decision, as well as Canadian inflation and Canadian retail sales. That won't affect, U.S. markets too heavily there, but that is kind of the major announcement for coming up this week. All right. Now, the next thing I want to do is let's jump to actually we'll go into the other news, okay? So, as you see, I don't know if you've heard, but US credit rating downgrade could add to pressure on government debt, right? The loss of Moody's AAA rating comes amid concerns about fiscal trajectory and widening budget deficit. U.S. government debt may come under more pressure this week after credit ratings agency Moody's stripped the U.S. of its top-notch AAA credit rating. Moody's dealt a blow to Washington last Friday when it downgraded the U.S. and warned about rising levels of government debt and widening budget deficit. It cut U.S. credit rating one notch to AA1, becoming the last of the big three agencies to downgrade the country from AAA. Um, so here's what a couple of things, okay? The first part is let's get into like a little bit of opinion around it. And then the second part is let's look at this um and let's look at as it is in the charts and kind of forecast what may play out here, okay? So couple of things. He said that is he the is it better? So, it's not really skewed at all. Credit rating is credit rating, right? It's think of it this way, like if you had a credit score, right? Your credit score is your credit score, right? So, it just is what it is at that point in time, right? You can't do anything about it. It can change, it can go up, it can go down. I look at this as a couple of different ways. Okay, the first is like it could be a good thing. It could force Congress, it could force government spending to, it could force them to cut some of the bloat from their spending. It it could also, it could change what programs. I guess that's really just the best way to put it. It could cut bloat from spending, and it could help, tighten up the budget, if you will, for the U.S. government as it's been ever expanding. And mainly, here's the thing that I'll say that I've realized a long time ago about the government, actually, in kind of middle school, high school, when I first got interested in economics, is that whenever I've always found it funny, like a government program will say, "Hey, we're going to fund this program for the next 7 years to help build, repair the car industry or repair this industry, and we're going to give this incentive away or that incentive away," which it does its job in that moment in time, but then neither Republican nor Democrat vote to get rid of the program, and they don't let the program die. So now your program just keeps on indefinitely, and it just becomes another line item in a budget. And it's like, hey, if I'm already spending, 35 trillion, if I'm already spending, $1 trillion, what's another billion? You know what I mean? You know what I mean? Like, what's another billion? If that's the case, um, and I mean, that's really and truly kind of what happens. But I will tell you, there's been opportunity there have been cuts in government spending. Under this, people are gonna look. Let me just say this: when I talk about this stuff, just know, politics aside, this is not like the Democratic Party, pizza party, birthday party, house party. Doesn't matter what kind of party you want to be a part of in this room. To me, this is all about the money party, the greenback party, the pit party, the price action party. That's all I care about. So I don't care what politics you have inside the webinar. Outside, we can talk about it all day, every day. I don't mind it. Under President Obama, he was one of the first to cut HUD and Section 8 housing for those individuals that had been on it for X amount of years and hadn't have a job. They actually cut $8 billion from the program. And then, but there was massive spending. There was spending elsewhere, right? And it never really cut. It just shifted. And it reminds me a lot of how companies do budgets. Okay, it reminds me of how companies do budgets. I used to. My first job kind of out of college after I was not allowed to go into the military because of a hole in my heart. The first job I had was I was a regional manager for a property management company. And I think it was like $212 million worth of properties underneath my kind of purview. And I remember one of the things that I always try to do is I was budget conscious, right? I thought if my property spent less, made more, and we did things properly and effective budgeting, then we would get rewarded. Well, little did I know, after like halfway through the year, my regional the person above me comes to visit me, and they're like, "Hey, look, you need to spend your budget, otherwise we lose it next year. So spend it away, spend. As a matter of fact, go 10% above it so they give us more money next year." And I'm just like, wait a minute. That's not a smart business move, right? But that's how what we see in the government as well, you know? And it stinks. So this happened, and it has happened before. In 2023, Fitch Ratings, they downgraded the US, and then S&P Global Ratings did so in 2011. So this is the third time that we've seen it. So what I'm going to do now is, I don't know, and guys, look, I'm not here to sell you this tool. I'm just showing you the tool. If you decide that you want to get the tool, just you can email me, you can email Brent or Andy or Antoine, or you can type in your phone number. I'm not here to sell you anything today. Just pay attention to what I'm doing with the tool, okay? So, and I'll explain a little bit about it. All right. So I'm going to click on this tool. This is one of the tools I use all the time. This is by Trades Trending. And what it really is, what my favorite aspect of it is it allows me to look back at historical price action. So, for instance, right, this is the SPY, and I can see so I can see what this has done back for the last from 93 to 25, the last 20 years, and the last 10 years all at one time. Okay, and I can see, hey, is there any like trend? So here's May 14, 15, 16, 17, 18. And from kind of May 17th to the 20th, we have like a retracement from 93. We have a retracement in the last 20 years, and a little bit of a retracement in the last 10 years, right? But we have a benefit. We know that 2011, the credit rating went down in the US. So if I just hit apply, and I can turn off some of this, right? And I can look at, hey, what happened when the credit rating happened in July? Wow, look at that. Did the market react to that credit rating happening, downgrade that happened in July? I'd say so. Reacted pretty heavily, you know? And then if we wanted to look at 2023, we can look at 2023. Now, if I overlay that on 2025, well, we had the timing lines up pretty accurately, for the most part in the pullbacks. We did have a peak in 2011 there and a trough there. But overall, if we start looking at like the last 20 years and 10 years and even the last 30 years, you can see the trend just it repeats itself over and over and over again. So if we anticipate that there may be a little bit of a pullback, well, let's just see what is there to cause us to create some potential pullback. Well, I'm going to add on one thing here. Let me add this on, but I don't like to look at all that stuff. I'm just letting you know. I like the simple to me works. Okay, that is me to a T. Simple works in my brain. All right. So, and I could even, if I wanted to, just like that. Okay, so all I'm really looking at are red dot, blue dot. So we had a red dot here, told us to sell. Great, perfect, cool. No blue dot there, but let me actually turn that last back on. We are still seeing selling opportunity in here. Okay, the blue dot means buy, by the way. The red dot means sell. We're still seeing selling opportunity in here, and I'm going to turn off these EMAs and we'll talk about those later. But if you look at this, we have a gap in the market, and this is the SPX from 5786 down to 5719. We also have another gap in the market at 5307. right? And that's from this kind of movement up that we've seen. If we use Fibonacci's here, which I don't know, so if I go from low to high there, and that's our kind of weekly looking fib, we're in the blue zone, so that means we could potentially sell to this area in the blue. However, if I look at my sub fibs and go there to there, we hit a de-extension. We haven't formed the to the left to the right high low, but this could pull back, and we would be well within a red zone pullback to allow us to know that, hey, the market could scream higher potentially, but I don't know if it will. But however, I will say that there is potential for pullback coming. The other thing is, we're seeing an outflow of volume and energy from the SPX and looking to kind of push down. Okay. So, is this going to sell off? 100%. The answer is I'm not going to predict it 100%, accurate all the time, right? Sometimes I'm going to be Nostradamus and sometimes I'll be Nostradamus. But if you look here, what am I anticipating is really, I got a few LOLs on that one. Thank you. Thank you. I try. Part-time comedian here. Um, what I'm going to look for is I want to stack stuff into my favor, right? When energy is weakening out of this, I'm not going to look to continue to buy up. I am going to wait for it to break a counter trend line, and then I'm going to set a target for here at 57.1941. If I want to reflect, what is that going to look like on the ES? Okay, exactly, Chu. Fill the gap. That's what I'm looking for, right? If I'm going to go to the ES, go to ES, and the ES on the daily, it has a gap right in line with the other gap. It has a gap right in line with the other gap. So again, very similar, but you can see on the futures, this sell line is about to cross potentially sooner rather than later. Let's take those off because those are tied to my 15-minute. And I'm gonna add on the market energy. Oh, not market energy. We're already looking at that. I'm gonna add on the hedge fund trender. And again, I'm not going to look at all the pink and the blues and all that. I'm just looking red dot, blue dot. That's kind of all I like to look at. So if we get a red dot here, which I honestly anticipate a sell-off coming in the next few days, come Monday, I think we see a gap down, not a gap up. Because here's what happened, okay? Last week on Monday, does anybody remember what happened and what kind of announcement really pushed the market? Does anybody remember what happened, what pushed the market? Type it in if you remember. Let's see. Trade deal, China. Best way to say it, right? Trade deal with the UK. That happened the prior week. I think that happened Thursday of the prior week or Wednesday of the prior week. Bryce, China. That is correct, right? Everybody, China. Basically, last week over the weekend, it was announced come right before markets opened. Wow, so funny the timing. Right before markets opened, that hey, the US and China agreed to a 90-day pause on tariffs. Well, here's one interesting tidbit. Let me see if I can find it. Hold on. I'm gonna look over here. Um, US issues tariff on. Let's see. What was that? Hold on. News. So I'm trying to find it. I can't find the article here. It's on my Bloomberg terminal. But the US has already, though, even though there was the pause, we still issued the tariff on Temu and Shein and these like cheap sites that where people were buying like knockoff whatever. So I believe that this, when that kind of becomes even bigger news, as well as this Moody's downgrade, I'm telling you now, I could write the script for Squawk Box and Squawk on the Street, right? They're going to talk about how bad this is, and we're just going to see a bloodbath in the market. Let me tell you where the big opportunity is from that as well is um I'm going to use this. I don't want to. We'll go ZB, the bond market, right? What do you think is going to happen with a debt downgrade? You better believe this thing is going to have another little sell-off, okay? You better believe this thing is going to have another sell-off. So, look, this is going to, this will sell off. Bonds will get weaker. Now, how many of you don't know why the US credit rating is important? Type in a yes if you do not know why that is. Sometimes I get past myself. If you don't know why why this credit rating thing is so important, just type in a yes, and I'll explain it really briefly. Okay, thank you. And I'm gonna say your names because I don't want people to feel left out. We're a family around here, so be free, okay? So Andy, thank you. Deward, thank you. Placid, thank you. Steve, thank you. Thank you. I have your new contact. Thank you as well. Okay, perfect. That's enough people for me. So why is it important about the credit rating reporting? Think about it. It basically says who is able to service their debts. So, in the history of the United States, we have not missed a payment to service the debt. It's generally interest only, but we haven't missed one of those yet. Okay. If you want to understand what happens when you miss payments, I think it was Argentina that private equity companies own now. Private equity company owns Argentina. Let's see. I believe, right? Yes, because um, in years ago, private equity companies bought all their debt, they defaulted, but when you default, they moved in and they were able to take over and run the country how they see fit. Um, so if you don't have an ability to service your debt, let me ask you, let's say you're the US, let's say you're Europe or you're China or you're Japan or you're Canada or you're Mexico or you're, any of these major countries and they have capital and they want to go put their money somewhere where they're guaranteed to get some sort of return, well, generally they would buy US debt. Now, here's the other part of this that I find really intriguing that no one's tied the connection yet, and I'm gonna give you my theory, but over the last 3 months, China went from holding one $1.3 trillion of US debt to $760 billion. That is a debt wave that they basically said, hey, we're done with it. We don't want it no more. We're cashing it in. You pay us what you owe us. Okay. So when they did that, that's one going to affect the bond market. But two, doesn't that signal like, hey, China doesn't want to invest in our debt. Well, doesn't want to hold us. And then they the trading is becoming an issue. And now you get this debt downgrade. If you were a random country Would you be a little more nervous about buying US debt? Probably. Probably, which is kind of why, like we talked about this last week's section, when I talked about the two kind of big fundamental new or markers of recession, potential recession coming in. Um, Let me see here, reset chart view. One was this is called the Shiller PE ratio. We can talk about it later or watch last week's session. But you have in 1929, this ratio told us that, hey, we're about to have a recession. In 2000, it said the same thing. In 2007, it said the same thing. In 2021, it said the same thing. And now we're getting another hint that there could be a potential recession, right? Let's see. Dan said, or the flip side, China has massive financial problems, so they may be cashing out to fix their economy. Dan, you're absolutely right. But herein lies the thing. It's not about, I'm going to say something's going to sound real bad, but a lot of times it's not about the truth, but much so, more so, swaying public opinion and perception, the optics, right? What is perceived? Think about it, Dan. Like if let's say Dan, let's say Dan here, you're gonna loan me $1 million, right? But then Bryce and Chu and Andy and Steven and all them were like, damn, that James, he owes me, 10 grand, he owes me 50 grand, he owes me 100 grand. At a certain point, you're gonna be like, wait a minute now. Do I really want to loan him this money? You know what? I don't think so. That's really what it comes down to. And so the perception could be different. The other thing is that, yes, they could be doing that, or it's also, you know, and we'll talk about trade and stuff like that here in a little bit as well. I do want to get to that because there's three big trading opportunities that I'm going to share with you all here in just a little bit. Um, Now this is a one marker. Now the other marker, and of course, you know me, I just had to close. Okay, I think I got it. Close the window here. All right. The other market marker is called the Buffett Index. And basically, anytime this is exceeded, like I want to say it's like 140% or something, or maybe it was like 100%. This has been a marker of recession, so or a pullback in the economy. 2000, major pullback. 2007, we hit over 100% pullback. We hit over 100% here, pullback. 100% here, pullback. 100% here, pullback. 100% in 2019, pullback. 100% in 2020, massive pullback. 2021, big pullback, and right now, 200%. And what this is the value of all stocks over GDP. So that tells me that there's potentially an issue, right? Tells me there's potentially an issue. These two things are saying, hey, red flags. Now, stick with me because after this, I'm going to give you guys potentially three to four big trading opportunities. But really quickly, I'd be remiss if I didn't share this with you. And I'll show you why here in just 1 second. How many of you have ever heard of sequence of returns? Who in here has ever heard of sequence of returns? Nope. Type in a no if you haven't. That's totally fine. Type in a yes if you have. No, 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 no. Beautiful. Hey, that's great. I'm look, I get to learn you something today, okay? I feel like I get to do something here today. So I'm gonna explain it using this spreadsheet, all right? So on this side, and I'm gonna highlight this in yellow really quickly. This is the actual returns from the S&P 500 from 2014 to last month. Okay. So if you would have invested $100,000 in the S&P in 2014, at the beginning of 2014, you'd have $299,967. That also goes for right? Anything else. But in the S&P, we had a negative year here. We had a negative year here. We had a negative year here. And we had a negative year here. Basically, what sequencing of returns discusses is the ability to offset negative years, even with 0 years, gives you an extremely better return. So what I did to illustrate this was the S&P 500 with a 0% floor. Now, this is one of the things that I do and I talk about, I know I have some clients in here. I know I have some soon to be clients in here as well. And I'm so glad that you guys have joined me in and allowed me to help you guys and serve you guys. But a 0% floor, right? If you just change the negative year, the same negative year to zero, the same negative year to zero, and the same negative year to zero, and to zero, you would have 415,727 versus 299, right? Oh, absolutely. They say no negative 2 years. Absolutely, you're right. 100%. But take a look at it. It doesn't matter if it's negative. We actually have had 2 years of negative returns in the S&P. You just have to go back throughout history to find it. But look at I mean, which would you rather have, right? I know this is going to sound like a dumb question, A or B. Which would you rather have, A or B? At the end of the day, obviously, everybody in here would take A, right? Everybody in here would take A. It's a very simple thing, and it's a this is true, like one of the truest values that I've brought to people, and that is this. Okay, there's a new product that it's not new. I shouldn't say that. It is a improved bonus structure and bonus product that was just announced beginning of this month. Okay, immediately you get a 30% bonus on whatever you put in there. And then every year you don't take an income, you get a guaranteed 9.5% return. So what does that look like, right? Even if the S&P did nothing, okay? If it did nothing and you made $0 out of the S&P 500, okay, you would turn, let's say, 250,000. You turn that immediately into 325, and then you get 9.5% on that every single year. So in 10 years, you've more than doubled your money to 562,000. In 20 years, you have $800,000 simply based on the 9.5% guaranteed return. Now, if you assume that the S&P grows at a standard 8.2% over a 30-year period, right? You turn 250, let's see here, 250, 123, into $865,000. Okay? Now, that's the true benefit here of what this could mean for you. And if you want to find out more about it, I'm gonna send you all a link right now. Um, look, I'll tell you the name of the link is Financial Review. Um, and there you go. Andy, absolutely, you can take some out every single year. Um, Rob, I think it's 25K is the minimum. So, and we can do 401ks, IRAs, anything like that as well. And then additionally, you know, Andy, that's free in that as well. You know all about that. That's why you asked that. Yes, you can take an income. Again, I don't know. I'm in that zone, right? Sammy, that one may not be, but regardless, there is something else that we can discuss as well. And this is a little bit more riskier. So if you're on the risk profile and don't mind risk, this is the returns of our actual fund. Okay, so we've beaten the S&P by 100% over the last 11 years. Basically, if you had invested 250K with us when the S on those same years that I just showed you, you'd have 2.72 million versus 900,000 as of right this very minute. So, that's another thing that we can discuss when we have our meeting. There is a larger minimum for that, and I'll talk about that one-on-one. But, if you want to book time with me, use that link. I'll send it out again. And there it is. Now, I'm going to give you guys so go ahead and do that. Now, everybody get ready to write stuff down, take a screenshot, um, whatever kind of a thing you need to do, go ahead, get ready for that because we're going to go through a few different trading opportunities, okay? So the first I'm going to do is, why is this not working? You know? Okay, so we already talked a little bit about bonds. I expect the bond market to begin to fall. We are seeing the crossover on the daily here already. And as you know, futures have begun to trade. So if we go down to like a 5 minute, well, there was the announcement and there was the effect of that announcement. So it probably will hold steady until the news rolls out. Now, the next one, I don't know if my man Ron is in here, but he texted me this weekend about this, is gold. Okay. So, gold, right? I talked about a rebound trade on gold, right? About how I believe that gold will push up into this gap and fill this gap. And we talked about it like last week on Sunday, which was what, the 11th? So we saw obviously it had fallen, but I was not ready to issue that trade yet. But here, even if you took it, right, we had a nice rebound in it, and we're probably about break even from Sunday. And now we just had the gap up, and we're probably, I think what we will see, in my opinion, out of gold is this move here. All right. We're going to see it pull back, fill this gap right in here, giving us about, an opportunity in it to buy one more time and then rally up to at least this 33.27. Okay. That's where my next gold trade looks to be. All right. Now, if I want just kind of historicals on that, historical data. I just invented a word. How about guys? Can we just pause for a second here? Can everybody? Can you all? I don't care if you love them, hate them, whatever. When sometimes I love public speak. I really do. I love public speakers, and I like when people go on their rants or something like and stuff like that. When President Trump said, "I invented a new word. It's called equalize," I about lost it in that thing. I don't care if you love them or hate them. That was funny. Okay, I was like, "Oh, brand new. Just never heard of it before. Equalize." You gotta admit that was funny. Okay, so if we look at gold. Exactly. Strategery. That's it. That's it. I love it. Right. If you look at gold, right, gold has been the asset of the assets over this past year, breaking all sorts of trends, but really down into, beginning now, or beginning really right now, as of today, we should have another spike up, then another slight pullback, is what historically we have seen. But gold has done anything, but even and people say, well, how does it, I don't really know if I believe in the seasonality. Guys, look right there. You have a low, a low, a low, a low. 30 years, 50 years, 20 years, 10 years, showing you all the years. Okay. I'm looking at this as got that pullback already. So perhaps we're looking for the next ride up because people are going to flee to safety tomorrow. It just is going to be it. Okay. Oh yeah, Bigly. I love that one too. Right. We're going to see probably gold move up. That's another trade. So if you want to screenshot that and just type in done when you got it screenshotted. Now, the next one that we will do, GC is that symbol. Okay. GC is that symbol. It's right here in this top left corner. So if you trade gold, the futures, then that's fine. I'll look at GLD as well. Just be careful before you enter this. Okay. Don't just enter it blindly. Like if you see that stuff is still selling off, then don't just jump into it. That would be a fool's errand. All right. So look, right? Look for this to just fill the gap up to 306 here. Okay. That's what I'm not looking for a massive move. I'm not looking for an all-time high. I'm looking at, hey, we're going to see a little bit of a fall, maybe down to here, and then the rally up to fill into this 306. But I want to see buyers move into it first. Okay. Okay. GLDM, let me see. GLDM. Depending on, any fees associated with it, I'm fine holding GLDM. As long as you can hold it, it's liquid enough for you to get out of it when you want to get out of it and get in it when you want to get in it, then I'm fine with that. Okay. And no fees, that's even better. Okay. Exactly. $7 move. There you go. Okay. Steve. Now, my next trade, this gets into kind of one of the things that I think is probably, and here's what this is going to be personal opinion. Okay. I believe what I'm about to talk about now is probably going to be the biggest trading opportunities and investment opportunities over the next, let's say, from now to about 5 years from now, which is energy. And I believe personally that nuclear energy is where we are going to. You can look to Saudi Arabia. You could look to Dubai. You could look to New Cairo in Egypt. You can look to China. You can look to many other countries that have reignited nuclear energy. Now, why? Why was nuclear energy bad? Why was it good? Well, I'll tell you now, the bad was that very simple. Okay. The bad was really simple, really easy to understand. We were using reactors that were built in the 50s, designed in the 40s, with materials from the 30s, right? It different perception, right? Uranium enriched rods in small local nuclear reactors power naval vessels for years on end, right? Nuclear reactors and what the new way to build this, they actually have nuclear reactors that run on nuclear waste. Okay. Bro, I mean, how did you know? Okay. Oh, you can see it on the screen. I was like, wait, how did he know I was about to get into that one? Here's the thing is that we already have our second nuclear reactor about to come online in the US this year that was built and rebuilt. But some of these nuclear reactor technology companies, they're able to use nuclear waste. There is enough nuclear waste sitting in Kentucky and West Virginia to power the US for free for 400 plus years. Okay, so here is one of the plays, OKLO. Now, look, I think this is going to be a great play. I liken this to I think this could easily be, potentially be like a double, triple value stock from here, OKLO. I personally think, would I enter right at this moment? I'd probably wait for a pullback into this like 31 area. But if you don't, maybe take a little nibble here. And this is a long-term play. This is not just like a quick, quick bite out of the market. This is something that, you'd want to hold on to for a little bit. OKLO, long-term play here, getting in at around 31 and then just holding it, right? If it gets to 70, 80, 90, $100, maybe take some money off of it. But I think this could be a great play from OKLO. The next one is LEU. All right, LEU. And that is looking at, again, I like this, but I'm waiting for a pullback in it before I begin to buy. Something around 76, $77 is where I'm gonna stay for my pullback. And even if you take it from 76 to 120, you just made, some great return there on the option. But LEU, right, is Centrus Energy Corporation, and they are really, really good. Um, Yes, they are, Rob. That is right. That is the next one. They help with nuclear reactors as well as uranium and things like that, and rods and other. It's another real good energy play. So again, looking to get into that at 76. Again, you can take a nibble here. Let's say you're going to buy, your plan is to buy $1,000 worth of company, right? Well, maybe buy 150, 200, maybe buy like 2 shares or 3 shares here in case it goes higher. But plan on your bulk of your trading to happen between 80 and 75. Okay, 80 and 75. Now, if I'm going to add on my moving averages that I like to use, we're well above everything. We have a golden cross, so everything's good to go, right? It's long term is up, but if it comes back to the 20-day moving average, which I don't mind, then bam, we're good to go, right? And the last one, SMR. They are next gen reactors, right? They do small localized reactors. This is a $24 play right now. It's cheap, obviously. Wish I would have bought it down here, but hey, it did just turn profitable. Surprise earnings, right? They do small localized reactors, where like the ones for military use, the ones they're putting in Saudi Arabia, China brought on 9 nuclear reactors over just after COVID. And that's what this company does. They're more in the design and building of them. So these are great plays, in my opinion. There's also one other play that I'll get to, and then I got to run here quickly, which is Disney. Now, look, I don't care if it's dad joke and coming in is about to be you're about to get hit with a dad joke here. Okay, I'm just letting you know, right now. That's what's about to come. I'm not a father yet, but one of these days, and I have this perfect joke right here. I don't care if it's Disney or Datney, this thing is going down. All right, Disney or Datney, this thing is going down. I'm looking for a pullback into 92 range from 113, and into this gap here as well at 106, and 192 is my kind of final entry there. That yeah, they beat earnings. They're riding high from the announcement of Abu Dhabi. They're riding high from the earnings beat. Parks are doing better. Streaming service is doing better. Their Hulu Play is doing better. Movies are coming back. Great, right? Great, fantastic. It's going to pull back because the market doesn't move in straight lines. Remember my favorite quote of all time: bears climb stairs or bulls climb stairs and bears fall out of windows. So I do anticipate Disney to get back into live in this $100 to $200 range. But I don't, and even higher, right? It could go higher, back up into. Do I think it'll be these 2021 highs? No, I think it'll be, in 150 to 130. Like this will be the new floor. This will be the new ceiling for a little bit, and we'll rally in between those two forever for a while until the next big breakout. But just know that I do believe this will come back and pull back, and we will have a great trading opportunity. So, beginning to wrap this up, are there any questions? Oh, XLF. Somebody asked me to go over that. We'll do that really quickly as well. And I'm actually going to switch this to the XLF too. So this is a really cool feature of this. You can actually look at like there's an AI algorithm, and I can look at financials, which is XLF, right? And I can look at large, mid cap, small cap, micro cap, and I can find individual stocks in there that are trending or detrending. So looking at XLF, interest rates being what they are, the only thing that worries me about XLF, for those that asking, I think yes, it could rally up, but here's the things that worry me about the XLF is one of the things we talked about, I think on Thursday. So just for perspective, I took a screenshot of this out of my Bloomberg terminal. Access, yes. So this is the seriously delinquent rates of homes in the United States as of March 31st. Or yeah, March 31st. 6.25 million people were 2 or more months behind on their mortgages. And to put that in perspective, 6 million people were in 2008 in the housing crisis. The highest section of those people that are behind are FHA and VA. Those two loans are the highest section of people that are delinquent on those loans. The other is renters. Renters are 2 or more months. 9.5 million people renting are behind on their mortgage as well. So, and then when you look at car payments also being behind as well, and credit cards being behind as well, um, you know, I like it to 54. I'm not gonna argue with you to 54, but do I think we're in for another run like this? The answer is no, right? The answer is no. I do not think that this is going to run up much higher, especially, the Fed will probably start cutting rates late this year, early in the next year, and that's when I think we see kind of that downturn happen, is late this year, early next year in this. Could it get to 54? That would be very optimistic. I like it at 54. If I were to draw up fibs, I could see it going to 54, right? But 52.54 is where resistance is and where the fib is. So we're already seeing energy fall out of this. So if this crosses over, know that that will be one thing. But banks are always kind of one of those plays that people look at when there is a pullback in the market, depending on if the bank caused the pullback, like '08, right? Obviously, no. But they generally are okay. Let's see. And UNH, take a look at that one real quick. Oof, UNH 291. Well, obviously they lost another CEO. Not to, wow, that was not a poor choice of words there. Poor choice of words there. Um, their new CEO that was appointed after their other CEO was killed. He left the company. Look, I think health insurance companies, they are a racket of making money. And you can't deny their profitability. I think that eventually, right, missing earnings by 2 billion or 1%, that's not a huge deal. The reason why the market reacted this way is you see all those green E's going back from 2017 to now. Well, they missed earnings. So, we're at these lows. I think this is a safe buy here. Um, Energy is picking back up. So I think could it fill all this gap up to 583? Yeah. What I would look to do is buy at 291. Whenever it hit 377 and broke above it, and maybe to this new level at 416, I would move up my stop to 370, 375, 365, somewhere in there, and ride this until it hits about 584 again. And then I just lock it in there and get out of it. Okay. Oh, David, I reported on that last year, right? Last year they were doing the Medicare fraud. I knew this was happening. That's why I got out of my position in UNH and was waiting to buy it. So stick with us, definitely. And you'll hear about that stuff all the time. Because of everything that I do, I'm extremely attuned to news and things like that. So, um, look, guys, I'm going to wrap this up here. And I appreciate all of you guys. How many of you guys are finding value in these sessions? Give me yes or no if you are. Andy, love it. Bryce, yes. Okay, great. Good, because obviously I take time from my family. Andy, I do like options. I leave that to yourself to kind of run through your options chains and things like that, and then also eventually I'll bring Tyson in on a round table and we'll talk a little options and stuff like that as well. But I am more of a simple options trader. I like buying calls, buying puts. I like simple works makes me money. Bill, I appreciate you, my friend. I was hoping Oscar Piastri would pull out that win today at Imola. I don't know if you were up for the race or whatever. Let's see. Thank you guys so much. I'm glad that you guys get value out of these. Now, look, again, really quickly, like if you guys want to book time with me, here, let me actually, I'm gonna copy this link again. You can either A, take out your phone, book time with me on that with that QR code there. I'll make it large, or B, you can just use that link. Okay. Book some time with me. Let's talk about, and make sure that you're set up to never lose again. Oh my goodness, I just see the Q&As with CEG and stuff like that. We will cover that next week. Look, these are going to keep happening. There'll be 2 weekends, one in June and one in July that I won't be. I'm actually going to be in Dublin, Ireland, in July, and I'm also going to be. My in-laws are celebrating their 40th wedding anniversary in June, so those are 2 Sundays I am going to miss. I'll try to have a recording done beforehand for you guys, or I may just do it like early that Sunday, and then have it record it and play at 7. But I will miss those two. I'll let you guys know those dates as we approach. Appreciate all of you. Book time with me. My goal is to help people retire well, stay retired, and pass on wealth to your kids, or whomever. And Bryce, shoot me a text. I meant to text you this weekend. Want to set something up with you. Maybe we can do a little golf for trading. So love it. Let's see. Absolutely. Chew, I love it. I love it, my man. So let's really looking forward to it, guys. Have a good one, and want to wish you guys health, happiness, and success at trading. Have a great evening.